Warning, this is all financial advice. You can invest in any way that will make you feel comfortable. This is just a full breakdown of the stock to help you invest into a company that will help you grow your portfolio for the long term. Thank you.
It's time to hone your skills. You'll certainly need it.
Hello everyone, my name is Kool-Aid Man 100X. How you guys doing? Welcome to Black Money. Black people, listen. What we're going to be reviewing is Dollar Tree and Family Dollar, because Dollar Tree bought Family Dollar. We're going to be looking into the company, on how something you can invest in, and see where this would be a good thing for a long-term investment. So the first thing we're going to be looking into is understanding, when we put something into a company, do we get something out? Which means we're going to be seeing if this company pay dividends. So let's see here. When I did was I just plainly typed in, does Dollar Tree pay dividends? And they do not pay any dividends, as you can see here. It never issued any dividends to the shareholders, meaning the investor does not receive any public dividend income at all. Which is kind of bad, but somewhat good, I guess, because you're just dealing with the capital gains of Dollar Tree, because it's a little bit of a thriving company, I guess, in the urban youth. So what we're going to be looking into is they don't pay any dividends to the company. So we investing in something that does not give us anything back, but long-term value, we're going to look more into it. So let's go right back into the Dollar Tree. So what we're going to be going over is the chart situation. So what I like to do is look within 6 months, 1 year, then we look into the 5 years, then we look into the max. So basically, I like to look into a company within 6 months, 1 year, 5 years max within the chart situation. So we're going to be clicking on 6 months. So within 6 months, you can see it's in the red, and you can actually see how it does within these 6 months. Within May 19th, actually dropped pretty low right here on May 13th, I believe, in 2026, which is pretty bad. So what we're going to be looking into is the 1 year expiration here, and we can see how the company actually getting an uptick, but we can see the fall within that years that is going. First you have an uptick, then it falls. I think when stuff happens, that's when they get an uptick within Christmas, shopping, food, stuff like that. And after a while it goes down because company people walking out, stuff like that as well. So when we look into the 5-year distribution, really not a good company to invest in long term, because you took a real big hit here in the 25 and the December 24 and 25 era. So this is pretty bad. So this is something that I probably wouldn't invest in long term, but it's totally up to you if you want to. So we look into the max overall of the company of Dollar Tree and Family Dollar together. We can see the uptick, but we can start seeing the drop as years goes on. So will Dollar Tree still be around? We'll never know. So the next thing we're going to be looking into is the cash flow. So we're going to be looking into the financials, and we're going to be looking into the cash flow section. The first thing we're going to look into is the net income. As you see here, in May 2025, we have 343.40 million. August, we have 188.40 million. November 2025, 244.60 million, and January 2026, 506.10 million. So they actually made more of a killing in their net income within January 2026 of this year. So very suspicious, but the net income did jump from a regular to that within a year's time, which is kind of weird in a way. So the next thing we're going to look into is the cash flow of operations. That cash flow operations is 483 to 419 million, 319 million, and 1.3 billion. So this is what I'm not understanding. If you net coming, the 506, how come your cash for operation costs more? Because I think this is due to the employees that's actually walking on, because they just keep putting money into employees to run the company. Then the full-on operation is how they run their company, is with getting merchandise, stuff like that. So that's not good. You're spending more on inventory and people than you do making the net income. So this is y'all average, but y'all hit it, but y'all spending more, as I would say. We're going to be looking into the change in inventories. They're both in the negative for the first 2 years. which should be 2025 and November 2025. But their January, they actually came out the negative, which is weird. But August, you had 20.20 million. So how did you make 27.20 then hit the negative in 2025 or November 2025? Because that was the biggest hit that they ever had, because when those stores open and stuff like that. But they came out of that in a positive, which 306. So this is their biggest year actually coming out the hole. So basically they fighting their own company, I would say. We're going to be looking into the cash flow investing. Now, this is where it gets interesting. Do they buy these stocks back? Do they invest in other stocks? And let's see here. So as we see here, within negative 2025 and 2020, it was in a negative, which was crazy because this is the money you had invested. So they didn't even have anything invested. They made the money back, and then they lost it again. Went deeper into the negative than they did, which would be 371.80. Then also they actually took a hit again this year, and most of the impact was in the November 2025 and 2024 era. So how you still in the negative with your cash of investing? So basically they're shelling out the company for stocks, but not buying them back to keep control of the company, which is not good, by the way. So that's crazy. The cash flow investing is not good. The cash flow for financing. Now, when you're financing a company, you just accumulating more bills, basically. And so as you see here, within that 2025, there was in the negative 430 million. Then it got worse, 1.20 billion. Then it came out of the hole such as 67.50 billion down there in 2026. They're pretty much going back to the billion. So I'm not understanding what are they financing to put themselves back in the negative. And that brings to my conclusion of their net income. They're not making what they're financing. So why are they accumulating more bills? That's a great question. So we're going to be looking into the free cash flow. Now they're coming out with 47.8 mil at the beginning, 628 mil. Then they jump back into the negative of 130 mil. Then we get into the 709.76 mil. So they were in the hole for the first year. Then in 2026, they made it out. But I'm not understanding if you're financing, all this money went into the finance. So what are y'all financing? That y'all are covering up or ensuring that people are taking things and stuff like that in the company, or you're losing buildings and stuff like that, or stuff and getting damaged. So what is being financed that's so high? Yeah. So the unlevered free cash flow. Unlevered free cash flow is something that there's money that's not touchable in that account, basically. So unlevered. So money you don't touch. So we start off with 61.20 mil, 643 mil, and they in the negative again. I believe this is due to the financing. So we're going to be looking into the 721 mil after the 79. Then they went back into the negative of 853 mil. So this brings up the financing that they put into this. So they pretty much, they net cash flow with they. Yo, what's up, guys? This your boy Kool-Aid Man 100X. I want you to hit the link in the description below for my Zero Investment books. We have a quick sale going on for $7. Link will be in the description below or in the comments below as well, so you can get a chance to get the $7 deal and other things that you want to learn how to invest and take your investing to the next level. So I hope y'all enjoy. I'm gonna catch you guys there. They made, and this is what they came out to, their net after spending all the finance. Which is, once again, not good to invest into. So we're going to be going over to the balance sheet. This is where it gets interesting for the balance sheet thing. So got my little script here. So we're going to be going through this one by one. The total assets. So when you're looking at the balance sheet, you want to look at the total assets and the total liabilities. And as you see here, it's just dropping. That's not good. That's not good at all. So what we need to really pay attention to the balance sheet is we're going to go over the total assets. So the total assets, that they currently have right now and other assets and liabilities and stuff like that. But the total current assets is 8.60 bill, they had this in the beginning, then they dropped down. And then dropped down a little bit and got back down there. They stagnant 3.45 bill. Now, this is interesting. You start off with 8.6 bill, which is a decent for total assets, but they're not making any money back because they're pulling out of that to put back into the company, which makes me curious. So the finance liability and the net income, where's the other money going? If you really want to break it down. So prepaid expenses. So this is where it gets a little bit more interesting. None. Why is that? So where's all this money going? So what are y'all paying for to put y'all in the negative so bad with the financing? Interesting. So we're going to be looking at the total accrued expenses now. The total accrued expenses is none again. So what made it curious is that they didn't have any recognition of the first time, but is 492.90 mil, which makes me curious on how, if your net income is like 500, so you lost another mil in incurring expenses. So what was the expenses on? What's the financing on? And why your net income is so low? If you got that almost 3 billion in total assets. So where's that money going? Let's pocket it at the total other long-term assets. Now the total assets, I would say, long-term assets. Now this is where it gets interesting. When we look at the total assets here, you see here, this is the total assets. This is what they actually have for long-term value. Then it drops down to 201. Your expenses is who y'all are pulling from your assets to pay your expenses. Is that what it is? I'm not understanding that either. I mean, I guess, but your total assets is the total complete assets is around 13.47 bill, but your long term is 201. So what have y'all invested in that can make you money? Because your net income should be higher because your total assets are 13.47 bill this year, and they've been stagnant, but you went from 18 down to 13. So are y'all pulling from your assets to keep the company running, if I might add? So that brings about the big problem there. So, yeah, so we go to the earnings. So as you see within the earnings in Q4 2026, the estimated earnings for this is y'all lost the revenue. Y'all went into 26% miss, but the uptick is 56 in your estimate. I would say that's good, but in a way, no. But if you're looking at total income for the quarter, they've been up for the past, they've been up for the past year because of the pandemic, but they were down, as you see here in the 2024, 2025, 2023 years. So they took some big hits within that quarter for 39, 41, 45, 45. That's not good. Then you look at the long-term values, they start going up 2%, which decent, but not good within revenue surprise when they're asking. So I wasn't seeing this being a good earning potential, but if you want to invest into it, that's totally up to you. But in my issues of it, it's not really worth putting all your eggs in one basket with Dollar Tree if you invest into the company, or if not work for the company. I don't even think they make enough to pay you. So even if you work for Dollar Tree, you won't even get ahead, even if you're making it within that confine of you understanding the company. Shoot, just in a day, look at it. So, I mean, totally up to you if you want to. So we're going to be going to the last thing I like to do is look up perplexity, and it gives you key issues with the company, and it tells you the bullish view and the bearish view. So what I like about this, it gives you a sources that you can understand in case you want to look it over yourself. But I just like reading the first line of these things. So the bullish view is that Dollar Tree 3.0 formats has a demonstrated continued ability to drive higher average tickets and market expansion without code value and positioning. JP Morgan maintains overweight the rates. So you're looking at this as being a commodity company, but the commodity is not where this company thrives. And this is where the bullish view. The multi-price rollout has introduced inventory gaps. So this is what I was saying. The finances, the inventory, the expenses does not match what they make in net income. And the inconsistency stock that have drawn analysis customers criticize, and the hiccups raise the risk and higher market shrinks and stuff. And this is where the closing of stores is happening. So when you look into these things and the sources of Dollar Tree, it creates an analyst a 20% year-to-date sell-off. So people are selling Dollar Tree. They're not holding. So that brings into the full effect of how is this company actually being ran if nobody runs it correctly? And where is this big chunk of money disappearing to in this company? It's not really breaking down what this company actually does in its own meticulous way. So when you're breaking down this company, this is something you can invest into long term. It becomes a savings account basically because it's always up and down.
So what is an analyst consensus? Analyst consensus refers to the average of different analysts' estimates about a stock's or security's performance, particularly regarding future earnings or financial metrics. It is an aggregated estimate that helps investors gauge market expectations and is crucial for financial communication. This consensus can also assist in identifying forecast errors made by management.
So this is a company I wouldn't really, totally invest into, but it's something I would have in an index fund or some type of, ETF or something like that, basically, which you can own multiple companies in one. That's where I put Dollar Tree because it'd be so up and down. So we're going to be looking into the analysis consensus. So we're looking into the analysis consensus. This is like a one-liner for me. I mean, you can look it up if you want to. It gives you the full breakdown of this company. I already read all of this, but the line that I'm mostly concerned about is pretty much this one. The consensus analyst outlook, the Dollar Tree, which is Dollar Tree, as May of 26 is currently a hold. How is this a company you can hold? Just like I said before, this is a company that you will have in a consensus, which is mostly a company that you will hold in a ETF, mutual fund, index fund, stuff like that. When you have multiple companies, this is something I wouldn't invest in long term or short term or anything. This is pretty much a company that you would put into pretty much an investment or index fund, ETF. So when we're breaking down this company and you looking at all the defaults of the earnings call, the closings that's happening, the bullish views that they put more expenses into the company financial holdings and the net income is not matching, and there's more information that is not being shared with this company for long-term use, I would not invest in Dollar Tree. But in an index fund or ETF or something like that, that's the only way I would invest in Dollar Tree, but solely invest into Dollar Tree and Family Dollar, with them being in that debt too of owning two franchise in one, which is very tough in its own. So that's why you see the split within the max and low situation, because them taking on that other responsibility and trying to turn over those other stores is not making any sense to Dollar Tree at all. So the long-term hold, yes, For an ETF, yes. Index fund, yes. But solely by itself in Dollar Tree Inc., no. I would not invest into this company for that type of, company in my portfolio. But if it's an ETF and you own in multiple companies, yes, because if this falls, another one can rise. And if it rises, another one can fall, and it takes its place over and over again. So you don't have to worry about losing any money in capital gains because you already know that company is an up and down company. If not, I can see it actually falling even lower and turn into like an Amazon situation, but not an open store situation in the future. I would say the next 5 or 10 years, probably so. You will probably be able to order stuff off of Dollar Tree website. You won't be going to no more stores like that. You'll still have stores, but you won't have them like you have them now because they're closing a lot of them down. So I hope you enjoyed this video. Black people, listen. This is a company that I would not invest in, but it's a company that you can invest in. So invest in your own way. I hope you enjoy. I'm going to catch you guys on the next video.